Now the topic before us is beyond the visible, analyzing balance of invisible trade in three scenarios. Here we are going to discuss balance of invisible trade. Suppose this is our country and this is the rest of world. We may be having certain goods which are in abundance, and so we export goods to the rest of the world. At the same time, we may be having shortage of certain goods, so we import goods, certain goods from the rest of the world. At the same time, we also export or provide services to the rest of the world, and the services such as banking, insurance, shipping, transport, export of services, providing of services to the rest of the world. In certain areas, we may be requiring the services from the rest of the world. So there is import of certain services. Import of services. So as a whole, we as a nation do export and import of goods and services. When here we are to talk about balance of invisible trade, what is the meaning of I? I means invisible. Invisible trade means trade which is cannot be seen. Invisible items means those items which cannot be seen, touched or measured. So here when we are to discuss balance of invisible trade, we will be discussing only about export and import of services. So in case of BOIT, we will be taking into account export and import of services. So balance of invisible trade is equal to or difference between the value of export of services minus import of services, or value of export of invisible items and import of invisible items. So it is the difference between a country's invisible exports and invisible imports. Balance of invisible trade is also known as balance of trade on services. It is a key component of balance of payment. We discussed that balance of payment has three components: current account, capital account and financial account, and balance of invisible trade comes under the head current account. Invisible exports means services sold or provided to rest of the world or other countries. On the other hand, invisible imports means services taken or purchased from rest of the world or other countries. Examples of invisible trade are services such as banking, insurance, tourism, transportation, other professional services such as consulting, engineering. So balance of invisible trade, invisible exports minus invisible imports. Here we will be taking into account value of invisible exports and value of invisible imports. So the balance of invisible trade may be surplus, deficit or balanced. Surplus balance of invisible trade occurs when export of invisible trade is more than import of invisible trade. Deficit balance of invisible trade occurs when export of invisible trade is less than import of invisible trade. Now the balanced BOIT occurs when export of services, value of export of services or value of export of invisible items is equal to import of services. When we are talking about balanced BOIT, here we will be taking into account that exports are roughly equal to import. We will be not taking into account 1:1 ratio. No. If the exports are say 6 billion, then 5.99 billion will be taken as balanced BOIT. Both the sides should be roughly equal to each other. The balance of invisible trade has a significant impact on the country's economy. If the country's exports are more than the imports, that is, economy is having surplus balance of invisible trade, then it means that it is getting more foreign exchange. That is, exports are more, imports are less, so it is there is net flow of foreign exchange. So it may utilize this excess money which is it is getting due to high exports for improving its economy, or it may use it to reduce its debt. On the other hand, if a country is having deficit balance of invisible trade, that is, imports are more in comparison to exports, so it will have to pay foreign exchange to the rest of the world for the imports. It means that suppose exports are 100, whereas imports are to the tune of 150. So what is difference? Minus 50. This is deficit balance of invisible trade. So it will have to pay 50 to the rest of the world. So to pay 50 to the rest of the world, either the country will have to borrow or it will have to sell its assets or use some other means. I hope you have understood all the three scenarios of balance of invisible trade, and that too in a very simple language. Now the topic before us is understanding the differences between balance of payment and balance of trade. Here we are to discuss the difference between balance of payment and balance of trade. Firstly, we should understand what is balance of payment. In this world, there are a large number of countries. A country may be having many things which it may be having in abundance, so it will be exporting those goods to the rest of the world. Some things a country may be having in shortage, so it will be importing those goods from the rest of the world. In the same way, a country may be exporting certain services to the rest of the world, and it may also be importing or receiving certain services from the rest of the world, such as banking, insurance, shipping, transportation, etc. Sometimes we provide aid to the rest of the world on humanitarian ground in the form of say money, food, medicines. At times, when there are natural disasters, say lot of floods or other reasons, we may be receiving foreign aid from the rest of the country. Then we are maybe having certain investments in foreign countries, and from them we may be receiving certain incomes in the form of income, dividend, profit, interest. And at the same time, foreign investors may be having certain investments in our country, and they may be receiving payment from us in the form of dividend, interest, profit. Sometimes we borrow loan from the rest of the world or foreign institutions, and sometimes we also provide loans to the rest of the world. Sometimes we make investments abroad, and sometimes they make investments in our country. So BOP is a systematic record of all the economic transactions which take place between the residents of a country and the rest of the world. We have already discussed in detail what is the meaning of balance of payment. So balance of payment is a very big concept. As already discussed, balance of payment has is three components. First is current account, capital account. Although I am using A/C in place of account, you are to write completely. And the third is financial account. In the current account, we take into or record the transactions which pertain to export and import of goods. Then we record in current account the transactions related to export and import of services. Then unilateral transfers received or paid, received and paid. We may be receiving certain investments, we will be also taking note of the same, and what in unilateral transfers we have paid, we will be also taking the note of the same. Then income from investments paid and received. In the capital account, we take into account the transactions related to acquiring or disposal of non-produced, non-financial assets and capital transfers. And in the case of financial account, we record transactions pertaining to foreign portfolio investment, and there is also official reserve account. We will discuss all this in detail. Now we concentrate on BOT. Here we have discussed we have an overview of balance of payment. So when we are talking about balance of trade, these two items, export and import of goods and services, pertains to balance of trade. Balance of trade means the difference between the value of exports of goods and services and import of goods and services. So from this overview, you can see that balance of payment is a very bigger concept, and balance of trade is only related to is a very narrow concept, and it as compared to BOP, and as it pertains to only it is only the difference between export and import. Further, balance of payment has three components: current account, capital account, and financial account, whereas balance of trade is only a sub-component of balance of payment. We will discuss each of all the differences between BOP and BOT in detail. Let us see. The balance of payment is a systematic record of all economic transactions which take place between the residents of one country and the rest of the world over a specific period. We have already discussed in detail the meaning of residents. Residents means individual residents, businesses, and government and its organizations within the jurisdiction of the country. In the case of residents, as discussed in the definition of balance of payment, does not include diplomatic staff, foreign military personnel, migrant workers, etc. On the other hand, balance of trade is only the difference between the value of a country's exports and imports. The components of BOP are balance of trade, unilateral transfers, income, investments, loans. Balance of trade is only a part of BOP under the head current account. Equation: balance of payment is the sum of current account, capital account and financial account because it has three components. On the other hand, balance of trade is equal to exports minus imports, exports of goods and services and imports of goods and services. Surplus balance of payment occurs when there is more inflow of foreign exchange than the outflow of foreign exchange total. When we discuss balance of payment, we record all the items. Here we record debit items, here we record credit items, and after listing all the items, such as if there is credit, it is a positive. When there is outflow of foreign exchange, it is recorded on the debit side. All the items which result into inflow of foreign exchange are recorded on credit side, and all the transactions which result into outflow are recorded on the debit side, and we make a total of the debit side and credit side. And if credit side is more than debit, it is surplus BOP, and if credit is less than debit, that is inflow is less, outflow is more, then it is deficit BOP, deficit balance of payment. BOT is surplus when exports exceed imports, and balance of trade is deficit if exports are less and imports are more. Significance: balance of payment is a wider concept. It provides a broad picture of the country's international economic activity, whether exports are more in comparison to imports. It will also provide what is the position with regard to unilateral transfers, whether we are receiving more in the form of unilateral transfers or we are paying more in the form of unilateral transfers, whether income received from investments is more or we are making more payment to the foreigners in the form of income on investments. And we will also understand whether capital transfers are more or less. We will have all this. So balance whether investments we are making abroad are more or we are receiving more investments, whether the outflow of foreign exchange in the form of investments is more, whether we are receiving more loans or whether we are providing loans, whether we are net debtor or net creditor. So all these points are shown by the balance of payments. So it is a wider concept. On the other hand, balance of trade is only a narrow concept. It is only concerned with export and import of goods and services. So at the last, we can say that balance of payment is a broader concept, and it also includes balance of trade in addition to other items. Balance of trade is a significant component. Significant means important component of balance of payment, but balance of payment captures additional economic activities beyond just the import and export of goods and services. It means that in the case of balance of payment, we not only record transactions pertaining to export and import, but we also record the transactions pertaining to other items such as unilateral transfers, incomes, investment received from abroad, loans paid or loans received, etc. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.